to a particular number. Let's set it to 162,003, and we'll set it by changing the credit loss value because we already have a vacancy rate loss. Alrighty. Other income, let's guesstimate 3,600. And gross operating expense, let's make that about 159,282. Net operating income is currently 137,335. Now for the pro forma, what we want is the actual rental income to come in at 376,068. So let's do a search, a what-if analysis. 376,068. We get that by changing the credit loss number. And let's say the other income is about the same as before. And the gross operating expense, 182,860, gives us a net operating income of 196,808. Now on the pro forma valuation, let's go down to the refinance terms. Let's assume that it's 6% annual interest rate, and it's amortized over 300 months. That's 25 years, and we want a debt coverage ratio of 2.0. The loan-to-value ratio will be 70% loan-to-value, and we'll deduct 3% for the refinance closing costs. Therefore, the gross proceeds will be $1,234,566, a statistical oddity. We're calculating a net cash out, which we'll calculate a little bit later. Now that we have the pro forma valuation basically filled in, we will now go over to the rehab and repositioning. This is a 12-month project. We are guesstimating about 2.5% of the maximum allowable offer to close, that is to buy this property. We're assuming $1,200 per unit, that's $93,600 with a 15% contingency. Now let's go down a little further and fill in the repositioning finance calculations. What we want from this deal is 90% primary loan to value. We're offering a 5% origination margin, that's the incentive fee. This will be private debt. We can also structure this as preferred equity or mezzanine financing or seller financing or a variety of different things. Typically it's just private debt. We're assuming an annual interest rate of 10% amortized over 300 months with no deferred payments. If it turns out that the actual net operating income is insufficient to service high-cost private debt, we can adjust the monthly payments by adjusting the deferred annual constant so that we're paying less than what is required from these terms, and therefore the unpaid interest is added on to the future value. Also, we want, on the equity participation side, we want 20 shares total in the membership, reserving 8 of those units for the syndicator. Therefore, the equity split is 40% for the syndicator, 60% for the common equity investors. We also want to reserve 3 months of debt reserves. And the syndication premium fee will be 4% of the total investment to value. Therefore, the total fee to the syndicator is $33,120 in this particular example. This number will change in just a moment. And here are the total funds. A very important number down here is the cash out return to the common equity investors. Here it's set to 200%, doubling their money, but in the slideshow we have 155.15% as an approximate cash out return. Therefore, we've taken this into consideration, and going back up to the pro forma, we find that the net cash out must be $387,202 in order to pay this return to the common equity investors after deducting the syndicator's cash out. $232,321 will be distributed among the common equity investors after deducting the cash out for the syndicator. That represents 155% return to the common equity investors. That is, the purchase price per unit was $12,479, and the cash out yielded $19,360 to the common equity investors. They get all their money back plus 55% profit, and if this money is reinvested into real estate, it is tax-free. Now we also scroll down to the listing broker data and plug in the various fields so that we can generate the mail merge templates. Now let's save this spreadsheet. And jump over to Microsoft Word. Now let's generate a mail merge template. Start with the letter of intent, private financing, repositioning. We always select no on this initial requester because it's looking for the source of the mail merge data in the My Data Sources folder. That's the wrong folder. We want to look at the folder in which we just saved the spreadsheet. So select no. And now we will select the spreadsheet. Select mail merge valuation. This is where the cell values have been populated for the mail merge. And now select preview. And now we have our letter of intent. The listing broker data has been filled in. The street address filled in. The MLS filled in. On the next page we have a summary of the actual operating data as well as the repositioning effort cost estimate. Now you'll notice carrying costs, we have some strange numbers here. This is a mail merge cell that is populated in the event that we have a negative net operating income and we must carry the property in addition to repairing it. Since the actual carrying costs are 0, I can just triple click this line and delete it because it doesn't really matter in this case. The property can currently carry the repositioning effort. Now since we're not adding in any finance charge on the direct repositioning costs, we can delete these two lines. Thus we have total repositioning costs $127,000. The all-cash purchase price has been filled in from the spreadsheet, $775,991. And there's other verbiage in here about what we intend to do for earnest money and closing dates and due diligence. And I have a JPEG image already preloaded in this template for my name, my signature. I can then save this document as a PDF as a letter of intent. Close out the document.